Hello, everyone, and welcome to our webinar, A New Look at Risk Characterization. My name is André Bergeron. I'm a partner with Gowling WLG. I've been here for a year now, and my practice focuses on transfer pricing analysis, mutual agreement procedures, and advanced pricing arrangements. Prior to joining Gowling WLG, I was an economist with the CRA's Competent Authority Services Division, working on advanced pricing arrangements, mutual agreement procedures, various international audits, specifically with the lens of doing economic analysis and conducting functional analysis profiles and determining an appropriate rate of return for companies and negotiating these results with the other competent authorities. I'm joined here today by my colleague, Pierre Allary, who will introduce himself.
Thank you, Andre, and thank you everyone for joining us today. My name is Pierre Allary, and I am a lawyer and partner in the Gowling's Transfer Pricing Group. I have been with Gowling's for 14 years, and my practice focuses primarily on transfer pricing and tax dispute resolution. As Andre just mentioned, the Gowling's Transfer Pricing Group deals with all aspects of transfer pricing in the Canadian market, whether that means preparing contemporaneous documentation for our clients or assisting them in their dealings with the Canada Revenue Agency, whether during an audit, by way of the mutual agreement procedure, an advanced pricing arrangement, or through an objection or appeal before the Tax Court of Canada. Some of you or your clients may have experience dealing with the Canada Revenue Agency, which we may refer to during this presentation as the CRA. The CRA has been one of the leading tax administrations over the last 25 years when it comes to transfer pricing, but they are generally viewed as one of the most aggressive tax administrations in the world. Canada is often referred to as a subsidiary country, and most of our clients are in fact subsidiaries of foreign parents in large multinational enterprises. Because of these dynamics, taxpayers in Canada are likely at higher risk of being subject to a CRA audit than taxpayers in most other countries. And as you know, when it comes to determining and documenting your transfer pricing, your analysis will examine the functions, assets, and risks of the relevant parties. And while a heavy emphasis is generally placed on the functions of the parties, the events of the last few years have generated a greater need to focus on the risks assumed by the parties. And that is why we want to speak to you today about risk characterization. Now, I will pass things over to Andre for the remainder of this presentation. Andre, as our group's economist, is uniquely qualified to speak on the subject after having left the Canada Revenue Agency to join our group just over a year ago during this COVID pandemic. That being said, I will be monitoring the chat, so please don't hesitate to use the chat function to send us any questions you may have about today's subject or about transfer pricing in Canada in general. We will do our best to answer all your questions before the end of the webinar, or we can connect with you afterwards. And with that, I will pass things back over to Andre for a deep dive on risk characterization.
Thank you, Pierre. Today, we plan on talking about risk characterization. So basically, I've divided the webinar into two distinct components. So the first one is really risk characterization itself. So we'll briefly talk about risk considerations pre-COVID and how I would structure or look at risk on a general basis in the documentation I would be preparing. And then we'll talk about recent events and their impacts on multinational enterprises, specifically considering these risk factors I mentioned in part one. In part two, then we're going to look at the transfer pricing considerations and how various tax authorities are going to look at changes that have happened over the past 2.5 years. So TP considerations in light of recent events and tax authority analysis and mitigation strategies on how we can address questions that would come from our tax authorities in our jurisdictions. So the OECD statement on risk analysis, I won't go through the details, but bottom line is in section 1.52, the OECD guidelines state the importance of a proper risk analysis in transfer pricing. This isn't surprising because we're always looking at the functional analysis, so the functions, assets, and risks with regards to determining the appropriate price for transactions within a multinational enterprise. And the OECD guidelines, the new issue from January 2022, reiterate that. But the bottom line is the level and assumption of risk is therefore dependent on economically relevant characteristics that can be significant in determining the outcome of the transfer pricing analysis. The Canada Revenue Agency, similar to many tax authorities worldwide, requires a thorough risk analysis as part of any functional analysis. And in Canada, Section 247 of the Income Tax Act will legislate TP requirements, and specifically Section 4 will outline the shopping list of information you have to consider in contemporaneous documentation. The risk analysis in the documentation. So normally what I look at are these elements of risk in any of the documentation that I put forward. So product risk, market risk, inventory risk, startup risk, credit risk, and foreign exchange risk. And the level of effort that will be inputted into the document will obviously be determined by the type of the transaction I'm looking at. So if I'm looking at an intercompany loan, obviously I'm going to focus a lot more on the credit risk, as the credit risk profile will ultimately determine the interest rate, etc. Whereas if I'm talking about a distribution entity, then I'd probably be looking more at the product risk. Who's going to be assuming the product risk if there's an issue down the line once you sell the product? And finally, with regards to market risk, then I'd look at what are the various impacts if there's a market collapse in a particular industry, and who will assume those risks. So prior to March 2020, and I'll caveat this right off the bat, from 2010 to 2019, in North America anyway, there's a period of relative economic stability. So after the Great Recession of 2008 and 2009, when the markets collapsed and there was an adjustment there, I remember looking at some of the comparables throughout that period, particularly in the auto industry in North America, and noticing there were a lot of variances in how companies reacted or were impacted by this crisis. But since 2010, in North America, there was relative stability there. So the reports were prepared, focused on functions conducted and assets contributed, because to some degree, unless you went very far back, you couldn't really measure the risks. And the analysis of risk and the ability to manage exposure to risk was really hypothetical in nature and discussed in theory. Benchmarking analysis and comparable sets reflected this relative stability. Now, I just want to, as I say that, I recognize that it's not the case for all regions. Between 2010 and 2019, there were various events worldwide that had impact on various countries and various regions. In Japan, you had the tsunami that had an impact on manufacturing in that country, and for all the multinationals that are headquartered there. In Europe, you had the credit crisis in the mid-2010s, and that had an impact on companies there, as there was a risk of default. So I don't want to say there's nothing that happened between 2010 and 2019, but I know from a North American perspective, there was a relative stability that we could work with, and at least that reflected itself in the comparables. So the first event I want to talk to you about, and I think there's no surprise here, is obviously the pandemic. So in March 2020, the COVID-19 pandemic was declared, and immediate lockdown impacts were felt differently in different segments. So on the one hand, you had stores that were closed worldwide, and then a lot of those businesses had to adapt and move online. Some other businesses actually benefited from this model, as you had a change in logistics and product flows and transportation. The services industry largely moved to a work from home model. If you did not have to go to the office, then you could stay home and work from there. Crude oil prices dropped significantly as demand for oil and gasoline plummeted worldwide. And then manufacturing was briefly impacted as what looked like a short-term lockdown ended up converting itself long-term. But from a short-term perspective, manufacturing entities were also sometimes looped into the general lockdown. Industries were impacted in different ways. So travel and tourism were obviously negatively impacted by restrictions on movement. This obviously included airlines, hotels, restoration, which on the restaurant side had an impact down the line on the agricultural segment and how food was packaged and distributed. Other industries benefited. So wouldn't be surprised if I talk about pharmaceuticals, healthcare, and building supplies appeared to benefit. So building supplies, I know a few companies, when we look at them from a comparability perspective, they had significantly increased as people could not travel anymore. So they started working on renovating various parts of their homes, and because they were stuck there. So some industries did benefit from the pandemic. The government relief measures was the next big shock, I guess you could talk about in recent events. So immediately after the pandemic began, governments worldwide enacted measures to help individuals and companies. In Canada, we had two specific sets of measures that were put in place. The first one really looked at companies and supporting companies as they were navigating through these changes. So that was the Canada Emergency Wage Subsidy, which helps employers affected by the pandemic. The second one was really more of a laid off or employee at home and how to support them, a bit of an employment insurance. So the Canada Emergency Response Benefit provided income support specifically to employed and self-employed individuals. And needless to say, there were millions that were spent on both these programs. As the CEWS was a direct subsidy to business, the CRA stated that it expects subsidies will not be netted from a transfer pricing perspective. So we'll touch on that a little bit later as to what that entails. But obviously, this is worldwide. This was an issue that needs to be looked at as different MNEs potentially receive these subsidies from the government. So the lockdowns brought obviously remote work. But remote work has its own aspects from a risk perspective that need to be considered. So as public health and social distancing measures implemented during the pandemic required jobs that could be performed remotely be done from home, then companies have adapted to and introduced fully remote or hybrid models, leaving behind office spaces and creating opportunities to relocate. And that's really where the crux of the risk comes into play. So individuals could work in the same city or opt to be in a different region or country. So for example, in Canada, there was a talk about housing prices in other regions would just went up incredibly. So in the Atlantic provinces, for example, a lot of people that are settled that are working in Toronto were looking at moving out back east, and that was creating pressure on housing prices in those regions. But in that case, we're talking about being in the same country. So what if you're in a situation where you could be working in Europe, in one of the smaller countries there, and you could move to another country? How does that impact the risk allocation between those countries if you start working in a different jurisdiction? So as risk allocation is closely linked to the individuals who manage and mitigate risk, their location is key from a transfer pricing perspective, as the value and the profits or the losses could follow these individuals to these jurisdictions. So it's one thing if you have a developer moving from Canada to the US and doing the work in the US. What happens when you've got actual decision makers that are opting to work in other jurisdictions? We have a file at the moment that we're working on where the executive committee of the company, there are often some changes as to which location, which country they're in, and that's changing the allocation of those costs related to that employee. The next big event was the microchip shortage. So as the pandemic unfolded, areas that were already exposed to potential shortages were pushed to the limit. So microchips were already in strong demand prior to the pandemic, mostly for manufacturing in vehicles and in laptops, etc. But the pandemic worsened the situation. So the increased demand for laptops and tablets to work remotely was obviously strained the system. And then companies started stockpiling and ordering them in advance, which put extra pressure on manufacturers to produce, and then those that were not in line to obviously order these products ahead of time ended up getting the short end of the stick there. On top of that, there was some of the articles I have read spoke to the winter storm in Texas, which impacted some of the microchip manufacturers there. And then there was a fire in one of the plants in Japan. So when you've got a limited set of manufacturers of these products, and you've got an impact on the manufacturing on top of an already worsening shortage worldwide, then that obviously doesn't help the situation. Toyota, Ford, Apple, and Sony slowed or halted production due to these shortages, and others have followed suit. But this has had an impact and a ripple effect down the line. So manufacturers are still significantly impacted by these shortages and are cutting production. We obviously hear this news on a regular basis. The next aspect is the supply chain. So there have been major supply chain disruptions and changes. So companies have had to adapt and restructure their supply chains to be flexible in the event of supplier disruptions or shipping delays. So one of the articles I was reviewing was talking about the cost of shipping containers is increasing significantly since March 2020, and same with air freight fees worldwide. So while most goods are obviously on shipping containers, because that's the most efficient way and cost-effective way of shipping goods, products like phones and tablets are shipped via air. And any time-sensitive product for the market would be shipped by air. Labor shortages in the trucking industry meant freight would stay in ports. This was particularly, there was a truck driver shortage in Europe. And then North America, increased pressure on railroads created some issues there as products were being held up in ports because there wasn't enough supply on the railroads. Then you add to that the Ever Given container ship that blocked the Suez Canal. I know we all remember reading about that. That definitely stressed the global supply chain. Anyone who followed that story, you may remember seeing aerial pictures of the amount of ships waiting to enter the canal prior to and then afterwards. And if you think that there's a crucial part on one of those ships and you're waiting on that to manufacture, and that has further delays down the line. And again, other references to China's zero COVID policy, have the workforce in some of the major shipping ports. So if you're impacted from that perspective also, and then you're slowing down some of the major ports that are moving out manufactured materials from China. So manufacturers and distributors have had to adjust quickly to avoid delays and resulting in extra costs in receiving and shipping goods. And finally, all this has led to inflation. And inflation has been one of the big talks over the past 6 months as countries worldwide have had to grapple with the effects of rising consumer demand coming out of the pandemic, and that's colliding with continued supply shortages and transport issues. Stimulus and government relief packages injected so much money into the economy that's added extra pressure and support to this rising demand. Increased prices have been significantly impacted along the M&E's production and distribution chain, creating new risks for consideration there. And immediate action by central banks worldwide to curtail inflation by raising interest rates have also had an important impact on the various areas of the M&E's affairs. Specifically, costs of intercompany lending is going to rise, and parent and subsidiary company credit risk profiles may change, which may require further analysis down the line. So in the next section, we're going to talk about how these risk elements play into transfer pricing within a multinational and how tax authorities would be looking at that moving forward. So how does this impact transfer pricing? So there are many implications for a multinational enterprise. For a distributor of goods, storefront closures can result in inventory risk, so creating obsolescence of products and spoilage, and credit risk for cash flow issues. Just think about a company that's not selling out of a location that has to pay rent. So how do they manage that from a cash flow perspective? So if the distributor was receiving an operating margin pre-pandemic, will they continue to receive that margin, and will the parent assume these risks? That's one of the first questions I would ask. For an R&D service provider, the ability to work remotely may shift some of the product risk So questions could arise as to the location of the work being performed and where the ability to mitigate the risk would arise. So think of prior to the pandemic, you had probably a team of developers in a room who are all of a sudden they're working remotely, and depending on where the work can be done, could be scattered around in different jurisdictions. So what happens with the creation, the value of the creation, but also the risk of a product defect? There's also government assistance, which raises questions regarding financial treatment of the subsidy. So which entity keeps the subsidy for intergroup R&D and marketing services, and how does this impact the cost plus if that's the methodology that's being adopted? On government assistance, for example, I know in Canada we specifically look at how an R&D company that receives subsidies would be treating this from a financial perspective, and how that impacts the cost plus they would be receiving from the parent. For a manufacturer, the microchip shortage creates delays and shutdowns. So delays and shutdowns generate lost revenue and further extraordinary expenses to be recorded by the manufacturer. Inventory could accumulate in the interim. Supply chain disruptions have forced optimal global M&E structures to be reviewed and be revised. So sourcing of products by manufacturers and finished products by distributors may change, and that requires a new approach to the transactions between M&E members as the supply chain is adapted to this new flexible model. And then finally, inflation has increased intercompany financing risks for M&E members as interest rates have increased. So credit risk profiles and arm's length interest rates between members will be subject to external review. So what has the OECD said on treatment of these new risks and recent impacts due to COVID and other aspects? So the OECD released a guidance on transfer pricing implications of the COVID-19 pandemic to help tax administrations and companies navigate this new risk environment. So of note, in terms of limited risk entities, the guidance says it would be necessary to consider specific facts and circumstances when determining whether a so-called limited risk entity could incur losses at arm's length. So if you're a distributor, are you going to be incurring some of these losses will really depend on the situation at hand. In section 47 of this new guidance, in terms of exceptional and non-recurring and operational costs, it's important to consider how these costs would be allocated between independent parties operating in comparable circumstances. And then finally, in section 65, they talk about the terms and conditions of government assistance and whether temporary or ongoing need to be considered along with the impact on the M&E transactions in a transfer pricing analysis. The guidance itself also goes into various considerations for comparability analysis and impact on advanced pricing arrangements from a go-forward perspective. So these are all interesting materials that you should take a look at in this guidance from the OECD. But the bottom line is the key takeaway is every transaction needs to be considered on its own to determine how related parties would have behaved. So what will tax authorities look for? Tax authorities worldwide will focus their attention on various aspects. So what are the pre and post-COVID terms of trade between the related parties? So if a limited risk distributor was receiving the operating margin pre-COVID, is it still receiving such a return? And if not, why and what has changed? So take the example of a company throughout 2018, 2019 was declaring a 2% OM, no problem. 2020 comes around, all of a sudden they're declaring losses, and from a go-forward perspective. So what happened and what has changed in the limited risk distribution profile of the company that would warrant that? If we're talking about a contract manufacturer that was not exposed to excess inventory risk in the past, is it still sheltered from these risks? And if there are changes, the documentation needs to demonstrate why these changes occurred. So what will tax authorities look for with regards to government subsidies and who benefits from these? So prior to the pandemic, incentive programs were generally targeted in nature. And I know in Canada, one of the programs that we have that's generated a lot of discussion has been subsidies from provincial governments and federal governments directly subsidizing wages in video game development. So the impact of the government subsidies was is already a hot topic here from a transfer pricing perspective. And it always comes down to who benefits from the subsidy and how should it be treated from a TP perspective. Does the subsidiary keep the government subsidy or does it go back to the parent? The general widespread use of government subsidies has increased this discussion as many companies have benefited from these wage subsidies. In Canada specifically with the Canada Emergency Wage Subsidy. So how are tax authorities going to look at this? Well, they may consider how the subsidiary would support the business and whether on wages to support services offered or on prices for the products that are manufactured. But bottom line is it's determining which entity benefits. In Canada, we have a transfer pricing memorandum, TPM 17, we call it, which specifically states that unless you can prove the circumstances warrant it, normally the entity in Canada will keep the subsidy and the company in the US will still provide a cost plus markup on the services done in Canada. And we've seen that applied in the R&D segment. So the next up is in a remote work model, where are the profit drivers and risk mitigation measures located? Now we're actually talking, a lot of our tax system is based on the location. And in a pre-COVID environment, employees are generally expected to be on site. So if the company was located in a specific city, then the employees were coming to that location to work. But in a remote work environment, how do you determine the jurisdiction of work? Are key decision-making functions migrating with the remote work? So tax authorities will probably review whether or not profit and risk is shifted with workforce migration, and documentation in terms of employment may need to be reviewed by the MNE to ensure that the appropriate functions, assets, and risks are delineated in any of the work agreements with their employees. So who bears the extraordinary costs related to personal protective equipment and shortages and supply chain issues? So I'll give you two examples here. The first one is many of the manufacturing companies that we work with have put in place a series of COVID screening protocols where as employees enter the site, they have to test, they have to put on equipment in order to access the manufacturing facility. In other circumstances, we know that supply chain issues and microchip shortages have created significant backlog in manufacturing. And if, for example, in a recent regulatory filing, General Motors stated that they manufactured 95,000 trucks in the second quarter of 2022 and put them in storage waiting for microchips. So what is the cost of this delay and the extra step in manufacturing? And who will ultimately bear the cost of this? So non-recurring and extraordinary items have been incurred by companies worldwide to keep processes moving throughout the pandemic. So GM in this case opted to continue manufacturing, put the vehicles aside while they wait for the microchip, but they're going to have to pay the extra step of having people put those microchips in once they come in. Efforts to track these costs will help determine the entity which should bear these costs. And then tax authorities may review ultimately what the pre and post-COVID scenarios were to determine if the costs would have been incurred by the entity in normal circumstances. So really, as you determine what these extraordinary costs are related to, then you would break down based on the functional analysis and the characterization of the entities, who should be bearing them long-term, and how does this impact the transfer pricing? And finally, how have interest rates changed the financial relationship between the MNEs? So the increased pressure on cash flow for companies as they assume extraordinary short-term costs related to the pandemic, and financing to ensure sufficient cash flow is the key consideration that needs to be looked at. Credit risk profiles may have changed due to the specific industry exposure in the pandemic, impacting third-party rates available to entities. So if you're in an industry that's suffered hard through the pandemic, and on top of that, you're having financial issues, then potentially the company's credit rating is going to reduce, increasing potential rates that you have to pay. And then finally, interest rates on intercompany loans may fall outside the realm of interest rates available for that credit risk rating. So what are tax authorities going to look at? Well, they might look at the financing arrangements of the entity. So if the loan was incurred to assume extraordinary expenses that usually would have been taken on by the parent, then would the interest rate be allowed? Potentially not. They might also ask for it. They might also look at the intercompany loan from on a yearly perspective. They'll look at the yearly test of the credit risk rating and then verify whether or not a better interest rate would have been available to the subsidiary or to the borrower that's looking at the funds. This has been an issue that we've been working on significantly with various companies here at Gowling, because Canada's been taking the Canada Revenue Agency has been looking at many of these loans and requesting a yearly test, particularly as interest rates have dropped from 2010 to 2019, and then how they will work with the interest rate drop in 2020-21, and then the interest rates increasing in 2022 is obviously a question that we're going to see later as we progress in time. So to conclude, the sequence of world events over the past years have created shockwaves in risk characterization with significant impact on transfer pricing. It's important that MNEs take a fresh look at their documentation on a yearly basis to identify how they have managed risk within the MNE. Changes in risk characterization between the pre and post-COVID periods need to be clearly delineated with a thorough functional analysis to support that characterization. And my assumption is that tax authorities are going to lean towards a constant and consistent approach from the pre and post-COVID period, and specifically target changes resulting in losses or transfer of profit or risk to other jurisdictions. From an intercompany loan perspective, I suspect tax authorities are going to start requesting a yearly test to ensure interest rates are arm's length. That concludes our presentation. I want to thank all of you for tuning in today to hear our views on risk characterization and how tax authorities may be looking at how your clients or companies are looking at transfer pricing in this new environment. If you have any other questions or want to reach out, do not hesitate to contact Pierre or myself. And finally, thank you again to Pride Partners International for inviting us to speak today.